Welcome back to Primary Source China Investment. This week for show F7, we're talking about China. Nobody knows anything. For months, we've had China experts around the globe pounding the table with two competing narratives. There will and there will not be stimulus. Both sides were adamant and staked their reputations. Well, maybe not their reputations, because it seems like being wrong has no repercussions. But here on this channel, we don't wade into predictions too much. We look at what happened. China's policymakers don't telegraph decisions well. And this contributes to the lament from Beijing that, the foreigners don't understand us well. Well, surprise policy shifts tend to make observers skeptical. So what happened? There was a slew of things you don't need us to tell you.
Firstly, let's see the real estate index. So USA real estate index is already moving up.
Yeah.
And secondly, everybody knows Federal Reserve will cut the rate in the market. I think probably China just waiting for the Federal Reserve to cut the rate and then start to push out the policy. I think the timing is really perfect. Since the cutting the rate and the market is already moved up, and then they just add a greater policy, a huge liquidity, totally change everybody's emotions. So right now, the bearish or whoever, all the people in the market confirm China back to the bull market, or at least get out of the bottom.
Yeah, 15% in 3 days is just, it's not, that's not what a healthy market looks like, but definitely it shifts the perception a lot. And that's really, maybe the focus here. I think the bigger focus is Beijing recognizing that they have to do something. The economy is, I don't want to say in trouble, but there's a lot of things that need to happen. If you look at, industrial profits just last month, horrible number. You look at, consumer sentiment, horrible numbers. These are the kind of things that, certainly politicians that need to get elected look at, but definitely, politicians in China have to answer to the people as well. The property is one thing that you brought up, Penghua. So the property market, specifically mortgage rates, were cut 50 bips, and that's going to result in about 150 billion renminbi less in interests for about 50 million households. So that's about 3,000 renminbi per year per household. Also, down payments went from 25% for second homes down to 15%. So yeah, 3,000 renminbi is not going to, a year is not going to change your life, but maybe that 3,000 renminbi for all of those homeowners will go down to pay down more debt, or maybe, invest a little bit, or maybe consume. And I think that's the real rub. Is that going to be used for consumption? Some of the other areas, the CSI 300, like we said, is up 15% in just a few trading days. Definitely, there are some people that are convinced. David Tepper, right out there in front. Goldman Sachs, another one, was, hey, fear of missing out is real. But there are still, there's the other side of the trade. And, Michael Pettis, who's well known on the ground in Beijing. And then there's China Beige Book, also not necessarily convinced. I did want to put a little scale here, because there was some announcements regarding the stock market that we should mention, because we follow that. And there's a swap program with initial size of 500 billion renminbi, allows funds, insurers, and brokers easier access to funding. The second provides 300 billion first batch cheap PBOC loans to commercial bank to help them fund listed companies' share purchase and buyback. But we have to look at terms of size. The market cap in Shanghai is 46 trillion renminbi and was almost 70 trillion a few years ago. 800 billion is nice, but it's too small to matter, except as a catalyst. And that's what your point is, Penghua, which is true. And Shenzhen is 27 trillion renminbi and was 40 trillion a few years ago. Again, a few hundred billion isn't going to chip the paint here, but it is the catalyst that many people are looking for. I did have this interesting chart where PBOC assets against the CSI 300, and you can see, just because the PBOC assets are growing doesn't necessarily mean the stock market is growing. And you have to remember that there's been a lot of stimulus history. 2008, 4 trillion renminbi economic stimulus plan on infrastructure, social welfare, rural development, April 15th, 2015. Interest rate cut, pension funds to invest in equities, relaxation of margin financing rules, March 2020, wider fiscal deficit, special bond sales, triple R cut, July 2021, tightened regulations on big ambition to support SMB and employment. So, there's a lot of stuff going on. And the rumors are that Beijing isn't done. They're actually going to just give cash to, poor people. They're going to those are called livelihood subsidies and special bonds by year end, and local tax cuts. Corporate tax should be reduced to 20% from 25% for eligible companies. So there's a lot of things that could happen as well. And I think, Pengwo, your point is this is the shift that a lot of investors were looking for. Would you confirm that?
I think from the investor's perspective, this definitely is a turnaround. So everything, as I know, entire the market, no matter the institution or individual investor, they all want to get into the stock market. So nobody want to missing the opportunities to make the money. So people definitely have a strong desire with that. And secondly, the China government, they already have the policy. The key things is they still started from the Federal Reserve. So they provide the liquidity, allow the institution, and they use the shares to as a collateral to get the money and then repurchase and do it again. So that's seems to provide unlimited liquidity to the market. So no matter what happens, they always get enough liquidity and money to support the market. And also remember, last time we talked about China companies that they probably have $1 trillion outside of China. They try to get the high interest in the United States. Right now, as long as the Fed cut the rate, those money will flow back to the China. So that will provide a very strong money support, especially to the Hong Kong. You will see the Hong Kong market get sold much higher than the Asia market. So all those things they combine together within the past 3 days. That is why the market sold almost 20%.
Yeah, I just caution, buying equity with debt is a very risky proposition. But also, you had rate cuts in the U.S., but the 10-year in the U.S. went up. So it doesn't necessarily step by step. I just want to finish this, but by saying, we are not stock pickers or market timers. We're all about allocation. And for years, we've said allocate to A shares, not US or Hong Kong listed names, and always hold some fixed income in your A share exposure. I would say it's the same advice today. So for all the US listed or Hong Kong listed, China tech, there are many, many great companies on the ground doing very well, paying strong dividends, and having their stock price increase in the same manner as these high-flying names.
That's definitely true. So because you will see the high volatility, so if you don't allocate some of the money to the fixed income, as long as if the market is down, I think you just cannot afford it within 1 day or 1 week. The loss is definitely far.
Yeah, there's like an old technical, the technical analysts, they say, gaps close. Like once you have gap up, you will then close that gap eventually. So, there is volatility out there. So, buyer beware. And with that, we're going to leave it with show F7. Thanks for tuning in. We'll see you next week.
Thank you.